Hi, everybody. Welcome to today's Catheta webinar. We are coming to you live on May 27th, 2025. I know already our Catheta webinars get their name from the Creek word for learning. And today you're going to be learning about understanding life insurance from your instructor, Shantae Moore, who's a certified financial educator with Native American Financial Literacy Services. My name is Brooke Warrington. I'm the Training and Development Specialist here at the Native Learning Center. We're also honored that you could come on for today's webinar. If you could follow along while I read the disclaimer aloud, this webinar provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes. The material discussed does not illustrate all possible scenarios that could be applicable. We also have our copyright infringement law printed here. So this is just a friendly reminder that the webinar materials are protected by copyright, trademark, trade secret, and other intellectual property laws. Moving forward, when you're on the learning platform, know that you can always find the recording of webinars, as well as all of the resources that have been included, like PDFs of the slides, over in the courses section. I have put a link for you for today's presentation slides already in the chat, and then they're also available in the shared notes. And once the recording buffers and generates, that will be posted tomorrow. Anytime moving forward that you would like to join one of our webinars while they're happening live, you'll just log into the learning platform and then you'll click on the green banner to join at the top of the screen, just like you did today. We do ask that you join with listen-only capabilities for the most part. It just kind of helps to cut down on audio feedback. And then if you've joined and you realize the sound is not coming out of the correct device, maybe you're trying to use your headphones, maybe you have a secondary speaker and the sound's not coming out of there, you can always go down to this little telephone icon that's at the bottom of your screen, and that'll pull up a list of your microphone and your speaker devices, and you can select the proper output. We do, of course, encourage class participation, and there are a lot of different ways to interact during today's webinar. We're primarily going to use the public chat. So if you don't yet have that open, know that you can go over to the messages panel and click on public chat, and that'll open it up. You'll see two messages from me. One of them is a link to today's presentation slides. We also have the shared notes section that's just below that, and there's links in there as well. If you want to ask a question, maybe you have a comment, if there's any kind of tech support issues happening that I can try to help you navigate through, you'll just open up the public chat, come down here to where it says send message to public chat, and then you can type in what you want to say, what you want to ask, and you can either hit your enter key or on this cute little paper airplane button, and that'll send it in where we all can see it. If you've maybe joined and you don't have your mic muted, not a problem. You can always come over here to where the little microphone icon is, and that will mute you. And then if you asked a question along the way and maybe you're worried that we missed it, you could come over here to the little hand raise button down at the bottom right hand of your screen, and that will raise your hand and kind of signal to us that there's something in the chat for us to check out. We would love it if you got the public chat started for us now. If you just want to take a minute, let us know your name, where you're tuning in from. It's nice to see all the different tribal nations represented in the webinar. Your work or your role in Indian country. It might have led you to today's webinar. It might not have. You might just be here for personal information. That's great too. And then your tribal affiliation if you have one. You might also just be a tribal employee and you don't have one. That's also perfectly okay. And then I have one quick warning. Just know that if you click on that little red hand menu that's all the way to the left-hand side of your screen, it is going to pull you out of the webinar. It's going to take you to whatever you've selected on the menu. Not an issue. You'll just click on that green banner once again to join. But I just want to give you a heads up that if you click on there, it is going to pull you out. All right, folks, while you're introducing yourselves in the public chat, I introduce today's webinar instructor, Shantae Moore. And Shantae, I'm going to make you presenter now.
Thank you so much, Brooke. I appreciate the introduction. And hello, everyone. I'm so excited to have folks joining us today for this important conversation, understanding life insurance. So before we get into the meat and potatoes of the presentation, I do need to advance the slides. I do have a disclaimer on my own because, when we're going through information in that's related to like the financial industry in general, there's laws that we have to be mindful of because they can change, especially if you're watching the recording. But also I want to make it clear that I'm not here to give any specific advice regarding life insurance. I'm here to educate. And Brooke, if you could give me the presenter functionality, I appreciate it, just so I can go through these disclaimers. Thank you so much. All right. So, first and foremost, everything here is designed for educational purposes only. Again, nothing should be construed as any type of advice. I will go through some examples and hypothetical scenarios, and that's just that. They're just there for hypothetical purposes. And the main thing, again, laws can change, and you won't learn everything on this webinar. Although I do, I hold proper insurance licenses, and these topics can get so in depth and involved. And I really just want to touch on a few points of understanding at a high level, and then maybe a little bit of detail under each area. So, I want to first recognize that, in several of our tribes, and for many of us, our cultural practices are to avoid conversations regarding death. Right? It's I just want to honor that. I know that sometimes, even with our cultural beliefs, we don't talk about that, we don't think about it. But on the contrary, as a financial professional and an educator, it's also a conversation that shouldn't be ignored. It shouldn't be avoided. So I just want to respectfully, recognize that, and I'm not here to offend anyone. Really, just to educate about strategies and solutions. Because no matter what, we all are going to, we're all going to leave here. We're all going to go home to the Lord, and it's not just about life insurance is what happens if I pass away. I hope that you all will learn that the conversation is much, much greater than that. It's actually about using life insurance as a tool, as a strategy for our families, our businesses, for our personal savings. And I really want to get into that part more so than anything. So Thomas Paine has a quote here. It says, "The protection of a man's person is more sacred than the protection of property." And I truly believe that. I truly believe that you are your greatest asset to your family, your ability to earn an income, to take care of them, to provide for them in whatever way, that capacity that is. And I believe you should protect that. When you think about protection of financial assets, it's called life insurance. It's really, for me, like I said, I'm trying to just be mindful of the conversation. For me, it's not optional. It's not, and I'll tell you my story and, some things that I experienced as a divorced mom of three. I'm always thinking about posterity and prosperity, but thinking about, what do I leave behind to my three children if I'm no longer here? What am I leaving them debt? Am I leaving them financial struggles? Or am I making smart financial decisions and putting financial solutions in place and strategies in place where they'll be okay, where they will be able to continue their same lifestyle if for whatever reason I'm suddenly no longer here? That's the way I want to approach the conversation for today. All right, so let's just kind of look into some like textbook, explanations. What is life insurance? So it's a contract with a life insurance company where you have beneficiaries who will receive a lump sum amount of money in the event of your passing. So it's a contract that you have with an insurance company, and when you pass away, your beneficiaries receive a lump sum amount of money. I like this description here, which is from lifehappens.org. It says that if someone will suffer financially when you die, chances are you need life insurance because it provides cash to your family after your death. This cash is known as a death benefit, which will replace your income and can help your family meet many important financial needs like funeral costs, daily living expenses, and college funding. What's more is that there is no federal income tax on life insurance benefits. So just that description alone, it just shows that not only will, when something happens to me, my family will receive this money, they're going to get that money completely tax-free, which is huge. If you follow any of my webinars, I always talk about taxes because the government determines how much of our money we get to keep, but life insurance is not taxed. But also, more importantly, that money can be a replacement of income, taking care of your daily living expenses. If you have children, for them to keep going to college, and obviously, any final expenses. So I want to just kind of start thinking about, like, what would these, if you receive this amount of money, what would it cover? Well, first of all, it'll just be immediate expenses. Um, we have some, obviously we have to plan for services, so funeral and burial costs. I hope, some tribes offer support for those things, some don't. And usually, it's out of our pocket that our family members will have to come up with those expenses. And oftentimes, unless if there isn't any life insurance, it's very, very hard for family members to, find that money. In my experience, in my personal experience, when I had a loved one that passed away, they didn't have life insurance. You know, now it's all the relatives have to step in and help. And unfortunately, it's some folks are already struggling, and it's like, wait a minute, how am I going to come up with thousands and thousands of dollars, and I don't even, I'm barely making it by just off of my normal life. And that's the burden we're trying to avoid, with having some protection in place. And then unfortunately, what we see is that some folks, they resort to like crowdfunding sources like GoFundMe, and trying to collect money online, and just asking for donations. And I think that's even a hard request to do. I know several people who had to do that. I'm sure they would have wished that that wasn't what they had to resort to. But again, not having contracts in place, um, it's really hard to come up with that money, especially without going into more debt. Other immediate expenses, if we were thinking about someone suddenly passing away, they're not working anymore, there's that paycheck is no longer coming in, especially if this was someone who contributed to a household financially. What if there were medical expenses? We got rent that's due, car loans. I mean, we're talking about your normal day to day credit card debt. That's something that a lot of folks don't necessarily consider, is debt can actually be paid off. Now, let's just understand some legal parameters around it. So when we have debt, any debt, and we pass away, that debt doesn't necessarily just disappear. If you like, especially if you are like a joint owner of that debt, let's say you had a mortgage between two spouses, a husband and a wife, or two partners, and they're both co-borrowers. I have a hard time with that word, borrowers, on a mortgage loan. One borrower passes away. Now the full remaining responsibility is on that remaining person, the other co-borrower, which means that they now have to carry the full amount of the burden of that financial burden. And so the scenario would be if someone had life insurance and they passed away, that amount of money or a portion of it could at least go to cover that person's half of the debt, or all of the debt. Obviously, if it's husband and wife, or partners. Um, Credit card companies can make a claim if they found out any debtors, anybody who has debt that you owe money to, they can make a claim to your assets if they find out that you've actually passed away. So, for example, let's say I had a $15,000 credit card with Capital One. And if, for whatever reason through this probate process, there's a notice that goes out, to a public notice that's issued. And if Capital One somehow found out that Shantae Moore passed away, and they were like, oh, wait a minute, she owed us $15,000. We need to be paid first. Now, does that happen? I honestly, I don't know any scenario where that's happened, but can it happen? Absolutely. And if a creditor, or even if it's like a local creditor, I mean, let's not think of some large national bank. What if you have some debt with a local, I don't know, vendor for whatever reason? They can make claim to your assets and your estate. And if you do have any money left, if there's anything left over, they get paid first. So having life insurance would be able to allow you to have your beneficiaries will be able to take that money and resolve those final debts, and expenses. We have taxes, estate settlement costs. So those are some immediate items. Ongoing expenses, again, that's just, think about having others who depend on you financially, or dependent on you financially, whether it's a partner, children. We live in a lot of multi-generational households where we have like grandparents who are helping support adult children and their grandchildren. So again, we're thinking of a scenario where the income is no longer coming in. Okay, that person passed away. Now there's a life insurance benefit to pay for some of those ongoing expenses, that the household was already used to that person providing for. And then if we get really savvy and if we have the ability, we can think about future expenses. As you'll learn through this webinar, life insurance can be used as an actual unique financial strategy to plan for future financial goals. For example, children can actually have a policy in place that can grow money, and that money can be used in the future for something like paying for college costs. Even adults can have, take advantage of certain life insurance strategies where they can grow money inside of a policy that can have money used for retirement. That's actually what I use my contracts for both of those future expense needs, strategically using life insurance. And I think a lot of people don't realize that, or even if you don't even have to get that strategic about it. I mean, let's say there was a $500,000 death benefit paid out to a family. We're not obviously spending that whole $500,000 right away. At least I hope not. I hope that, there's some financial guidance professional who's there to help that family to save a good portion of that money. When you're going to get a $500,000 check, again, this is hypothetical, that doesn't mean you have to spend it all. You can actually save it for those future expenses as well. So again, it's all about strategy. It really is. All right, so let's look at some scenarios and situations of who should have life insurance, because sometimes I do get questioned on, do I even need this? Is this necessary for me? And this is just some examples of where it makes sense, where it absolutely makes sense. Obviously, for partner couples, usually it's hard when one person income is no longer there. So partner couples with kids. So if that surviving parent, who's now solely taking care of the children, they have to pay for childcare. Maybe they need to pay for others to come and help help them around the home. I always think of like a father who maybe lost a wife, and the wife was a stay-at-home mom. Who's going to help with all the cooking and the cleaning and, chauffeuring the kids around that the mom was normally doing? He might need to pay for some help for that. Single parents. This is kind of the bucket that I fall into. If I'm the sole income earner in my family, I'm always constantly thinking about, if something happens to me, how will my children be able to maintain the same lifestyle that I created for them, or just to keep living? Will they be able to keep the roof over their head and the food and all the educational support, whatever financial support they needed? Absolutely, a single parent should have coverage on themselves. Stay-at-home parents. And this is what I mentioned earlier, because sometimes people equate, well, I don't work, so, I don't bring in income to the household. But guess what? You are a stay-at-home parent or a homemaker, maybe not just a parent, but you're a homemaker. You have a value to that home and to that household. And imagine if you were no longer there to manage children or the home, somebody's going to need to do those things. And there's probably a cost for that. Empty nesters. This is, I think for folks who, empty nesters is adults where their children are now out the home, right? Their children are grown. They finally moved out the home. If one partner of that, the couple was no longer there, that person will probably, that remaining parent will probably have a hard time maintaining, their lifestyle. Retirees, a couple of things here. A lot of people, in retirement, they absolutely need coverage, not only to potentially pay for estate taxes, but also I think a lot of retirees, and I would equate that to seniors and elders, in my conversations and experience, they want to leave money behind for their relatives, for their children and grandchildren and great-grandchildren. They don't, I see, especially in a lot of our family, a lot of tribal families, Native families. I was just having a conversation with a new client last week, and she said, if something happens to me, every possession that I have has to transfer on to someone else, has to go on to another, relative. It's all given away. And I was like, well, definitely incorporate life insurance. Have a huge, imagine leaving behind a true legacy where you have a death benefit that can only not only be given to your beneficiaries and whoever you desire, but what about leaving money for your tribe or maybe a nonprofit that you care about? I mean, really can dream and imagine about the legacy we're leaving behind. And then business owners, a lot of people don't necessarily think or, think about business owners in the same conversation with life insurance. There's a couple ways that business owners need to consider this. Number one, if you're in partners and if you're partnered up with other people in business, think about what happens if something happens to me. Will my partner be able to continue running this business, my business partner? What if I have a certain level of expertise and skill set? Maybe I'm the marketing person and they're the finance person. If I'm the marketing person and I'm bringing in all the business, if something happened to me and I'm no longer here, would my business partner be able to find that? Maybe they might have to, we could use life insurance on my life as we call it key man life insurance, to where my business partner can now receive that benefit and go and hire someone to, replace the skill set that I bought. Or even with succession planning, because depending on how the business is set up, maybe you have a partner, you both have 50-50 equal ownership into the business. And let's say you passed away and now your spouse, has that ownership. Again, it's dependent upon how it's set up. Your spouse doesn't run the business. They don't know the expertise for it. So there could be a life insurance policy in place to buy out the spouse, to buy out, that other partner and their relative, so that now the remaining partner can own that business moving forward and, hire key people for that. So I don't go into too much detail, but it's unique. A lot of people don't understand. And in addition, life insurance can be used for business owners for retirement planning, for executive plans and bonus plans, which I'll touch on in just a little bit. So if you all have questions throughout the chat, or throughout the presentation, again, feel free to put those in the chat. I'll definitely take those as we go along. All right, so let's talk about a couple statistics. So 44% of families would feel financial hardship within 6 months of losing their primary income earner. And I think that's realistic. I see that. I have seen families who have become financially devastated, unfortunately, because the primary income earner passed away. Or even if they weren't the primary income earner, someone else's, everybody's income in the household is significant, right? I've seen the impact where families just had a hard time. They struggled because of someone no longer being, part of the home. And then here's another statistic. Families do feel more secure with life insurance. 60% of life insurance owners actually feel like peace of mind. And I'll tell you a story that was related to me. It's actually a little funny story now. It wasn't funny at the time. But this 100% I can relate with, because I remember this was probably like 2017, 2018. I remember just like finishing up my divorce or going through my divorce. But it was a moment in time where I got really sick. And it was like all of a sudden, I'm usually otherwise healthy. I have never really been hospitalized besides giving birth to children. And all I know is that in the midst of a day or two, I was having really bad chest pains. Like it was so hard to breathe. I couldn't lay down, couldn't get comfortable. Like I was really worried I was having like heart issues. And I went to the emergency room. And I remember when I was in the emergency room, and I was by myself at this point. I think maybe my mother and sister came to visit, but when you go into the emergency room, they're running tests, and they're running all these tests, and they're like, we cannot figure out what's wrong with you. And I remember literally thinking like, oh my God, like this could be it. Like whatever this is, it could take me out. Like I was scared. It was the first time in my life where I was like experienced like like a medical, I don't want to call it crisis, but it was very scary. Nobody knew what was going on. I was having a hard time, all these chest pains. And I really had a moment in time where I was really scared, thinking like, you know what, maybe this is it for me. And in that moment of confusion and uncertainty and just being scared, there was a moment in time where I said, well, you know what, at least if something happens to me, my kids are going to be instant millionaires. And I remember being in the hospital, having that moment of peace and security, and saying, because of the life insurance coverage that I currently have, I know that, I mean, I would hate to not be there for my children, but if something did happen to me and I didn't make it out that hospital, they would be more than okay. They would have more than enough money to live their lives and to be taken care of. And it was crazy that in that moment I had that peace of mind, and so this statistic here totally relates to me when I had that medical experience. And come to find out, it was gas. I just had really bad gas. I think I remember like throwing up, and then I don't know, like instantly, like an hour later, I felt so much better. And they were like, "Oh, I think you just had some gas or congestion, or not congestion, indigestion or something." But it was like so scary. I'm like, how did I have that? It felt really, really like something was really, really wrong. Thank God nothing was wrong, and I was able to go home. But again, in that one scary moment, thank God I haven't had any more scary moments like that since. I had that peace of mind. I had that peace of mind because of, not only the life insurance, but other things that I had in place. So let's talk about, like, why do I need to apply for and purchase life insurance? Like, why should you care? Like, why do we even have the conversation? Well, a couple of things is, first of all, I think people have a big misunderstanding that life insurance, it's not like something you could just go out and get. Like, I think, and some folks think like, oh, whenever I want it, I could just go and get it. And that's kind of not true. You actually need to submit an application for it and qualify for a policy. Now, if it's something through your job, that's different because you don't have to qualify. You just elect for it rather. But for, true policies, and we'll go through some examples, you really actually have to submit an application and qualify for it, because you could get to a point where you don't qualify, and we'll talk about what you need to qualify. It could be medical reasons. It could be it could be too costly, depending on what your options are or what options are being presented to you. Life insurance could be something where it can get to a point where you either can't afford it or you just medically don't qualify for it. I also I don't like to depend on coverage that's offered through a workplace. Because some people say, oh, I'm okay. I have my job. I got some coverage through my job. Well, what if you get laid off tomorrow? You don't have any more coverage. It's not always, expected that the new employer will even offer that type of benefit. I just don't find it reliable. And I think you'll be probably better served getting something on your own, a separate policy that's not tied to your job. So no matter where you're working, you always have coverage. Obviously, we talked about having, life insurance policy will make sure that your family is not going to be financially devastated. There'll be some money there. Debts can be paid off. We talked about legacy, leaving a true legacy, and building generational wealth. We hear that term, generational wealth, all the time. I want to build generational wealth. I want to build generational wealth. Well, you know how rich families have wealth through generations? It's through life insurance policies. They literally bought, 3-4 generations ago, they bought hundred thousands, millions of dollars worth of life insurance that gets paid out to the next generation tax-free, and they redo it over and over and over. Life insurance is the easiest way to turn pennies into dollars. That, in my opinion, is one of the easiest ways to create generational wealth. All right, so let's transition a little bit also, because when I'm looking at folks in their financial situation, I'm looking at everything, holistically, like not just your investments or your debt, or last week we talked about wills and trusts and annuities and things of that nature. Milestone number 2 here, this graph here is called the 7 money milestones, which is, we call it your roadmap to financial security and independence. As a financial professional, if I go through all 7 of these areas of finance, these 7 financial areas in one person's life, I know that I'll be doing them a good job of helping them, establish some sort of financial foundation. And, the first milestone is getting financially educated, which you all are doing here by joining the webinar. Milestone number 2 is proper protection, which in this instance, when we use the word protection, we're talking about insurance, protecting against loss of income, protecting against having to, cash out all your savings, but also protecting what if you get sick and injured and I can't work. Insurance just falls into that category of protection. Proper protection makes sure that all the what ifs in life are covered, because we don't know what can happen to us. I've seen healthy people, pass away from COVID or something. You never thought, like, nothing like that would take them out, and it did. I mean, you never know those what ifs that can come up. Someone passes away prematurely, young, car accidents. It's just whatever it could be. And again, I know I want to recognize talking about death and can be hard for or offensive to some of even our tribal nations and culture, but it happens. You can't ignore that these things do happen. So anyway, it's not a mistake that proper protection is so early in your financial journey. To me, it's not optional, and a lot of people, the reason why they don't have insurance because they think it costs too much. That's totally not the case, which I'll show you shortly here. I truly believe that this is a foundational expense, not even expense, an investment that you should make in yourself. Even before you start like having putting money away for an emergency fund, before you start paying down your debt, before you start trying to invest in the stock market, you should have a proper life insurance plan in place. It's not optional. It really isn't. So let's go and transition and talk more about protection. Just get into understanding like what options are out there. How does that make sense for me? How do I determine if this even is a solution or a strategy I should consider? So, like I alluded to earlier, a lot of people have this assumption that life insurance, first of all, they think it costs too much. They overestimate how much it'll cost. But the second part of that is a lot of people underestimate how much they actually need. And just having those two assumptions means that most families, if they have life insurance, they don't have enough, or they don't have any at all because they think it costs too much. And I think that's the real opportunity here. It's a huge opportunity. Only 59% of Americans have life insurance, and about half of those are underinsured. This is a statistic according to insure.com from February 2020. So even if people actually did go and get a life insurance policy, they usually don't even have enough, and I'm going to show you like, how do we figure out, how much do I need? Because for me, and like in my experience, when I talk to folks, let's say they did have a policy, I usually see it tied to like auto insurance. It was bundled in. It's like a bundle something, a solution that was bundled in with other types of insurance, whether it's like home, auto insurance, renters insurance. And the insurance agent sold it to them just to get them a cheaper rate, I guess, a discount on those other insurance products. That's majority of how I see folks, if they have a policy on their own, or some folks maybe were trying to help out a family member who got into the insurance industry and they just got something. But for the 60% of Americans who do have insurance, they don't have enough. They don't have enough. And I want to talk about how do we determine, well, how much do I need? Because I said all that other stuff to say that we don't just pull numbers out the sky. We don't just bundle life insurance to get a cheaper auto insurance rate, because I hope the agent at least had a conversation to figure out like, okay, how much do we actually need? Not how much do I need to get you a discount on this bundle, but how much coverage do you actually need? And that's the first question we want to look at. So a general rule of thumb is to have 10 times your annual family income in a life insurance, policy. So example here, if you earn, $50,000 a year, 50,000 times 10 means that you would have $500,000 in coverage. Like that would be ideal. Because in the I guess the logic behind that is to think like, all right, for the next 10 years, my family will have the equivalent of my $50,000 a year income that they were already used to having coming in to the household. And hopefully after that, 10-year period, they should have been able to figure it out. it's 10 years for them to still live off of the income that I was providing. And I hope throughout that time they figured it out. Example two is if you earn more, if you earn $100,000 a year, you should have $1 million in coverage. And I know that can be a high number. People are like, oh my God, I don't want $1 million over my head. Somebody's gonna try and do something to me. I've literally had some clients who told me that. It was like, they looked at the partner and was like, now, don't you do nothing funny. Don't you do nothing to me. But again, if you think about it, if you contribute $100,000 income to the household, imagine you're the breadwinner. In that example, how else are they going to pay the bills? Is the remaining partner, spouse, or other relatives going to have to work harder? Like, we really got to think about the important factor is replacing income. Your family's already emotionally devastated. It's already hard enough that you are no longer there, that you are gone. Now, let's try to at least ease the financial burden that can come along with that. And again, it's just a real conversation. Here's another example of a method to use to calculate how much coverage you should need. This is more in-depth. It's called the DIME method. The DIME is an acronym here. It basically goes through these 4 different areas to calculate specifically, like, okay, how much, do we have in this area to determine your need? So the acronym DIME stands for debt, income, mortgage, and education. So debt, just the question is, Mr. and Mrs. Client, if one of you passed away, would you like all your debt to be paid off? Would you want your student loans to be paid off, your car notes, your personal loans, your credit cards, whatever it is? Most instances, they say, yes, I don't want my family to have to worry about it or be bothered by it or threatened by it in any regard. Now, to be fair, no, unless you were a co-borrower on that debt, you're not responsible for it. Nobody is responsible for it. But like I mentioned, if your creditors find out you passed away, they can't make a claim to any other assets you have. So in this example, the husband makes $40,000 a year in income. The wife makes $60,000 a year. They both have $30,000 of debt that they're calculating to say, if something happened to me, this is what I want paid off. Income is the same, 10 times your annual income. So 10 times his $40,000 a year income, 10 times her $60,000 a year income. That's how we got the $400,000, $600,000 amount. M is for mortgage. So another question, Mr. and Mrs. Client. If something happened to either one of you, would you all want the mortgage to be paid off so that your partner no longer has to worry about it? Or home equity line of credit, whatever that is that you might have tied to the mortgage. Most would say, yeah, actually, I don't want, my spouse to have to pay that mortgage all on their own or have to worry about it. And one thing to understand is if you have mortgage insurance, that protects the bank, that protects the lender. That does not protect the family in the event, a co-borrower is no longer, here. That protects the lender in case that mortgage is defaulted on. That's what mortgage insurance is for. It's not for you. It's for the lender. So I don't want you getting confused thinking like, I already got mortgage insurance. Yeah, that's not for you. That's for the lender. E is for education. So this is kind of like it, or it can be an open, area as well. So, education is just thinking about, do I want to leave behind money for my kids to still be able to go to school or college, whatever they're, working towards? And if you don't have kids, or if you do it, maybe they don't go to college. Maybe it could be, do I want to leave money behind to my children to help them get a head start in life, to help them start a business? If they do go to college, they have money available to them. Or if I don't have children, do I have, nieces and nephews or other relatives? Do I want to leave money to my tribe, my church, my favorite nonprofit? So you can really get strategic in thinking, like, what do I really want to do here? Legacy planning, generational wealth planning. And so as you can see, the husband, his, having the mortgage paid off and money set aside for the kids' future, both of them average $1 million in coverage. But when you think about it, somebody passes away, all the debt will be taken care of, their income will be replaced for 10 years, no mortgage, and their kids will still be able to go to school or live the life that they planned. Priceless. So priceless. You can't put a price on someone's life, the value, the economic value of their life, but you can at least financially see that we've eliminated basically all financial struggle, in this hypothetical example. So when we're having conversations, I'm going to talk about how to apply, which is working with a licensed insurance agent. Those are factors to consider, not only the debt that I have, my income, other factors will determine, like, how old am I? What's my health situation? Do I have children? Do I have a business? What's my role in that business? So you really want to start having a robust conversation with an insurance professional to calculate what makes sense for you. Just because that person got $100,000 in the policy doesn't mean that you should have that. You might need more. We call it calculating your insurable need. How much do I actually need, as far as amount of coverage? So now we talk about how much we need. Last thing we talk about here too is just talking about questions to discuss with a financial professional or an insurance professional, which is, what are your short-term and long-term debts, your goals? What is your mortgage payment? How old are their children? Do you have any assets to cover, funeral costs? These are questions that, really want to have an in-depth conversation. So as you can see, this is not just pulling numbers out the sky. We're being very strategic with determining how much do I need. All right. Again, feel free to put any questions in the chat. I'll address those. So now that we talked about how much we need, let's talk about what type of life insurance is out there. What type of life insurance are available to me? So no matter where you go, the insurance industry, typically the laws are the same. They're based on the state. But there's only two types of insurance out there, the two insurance options. They fall into two categories, which is temporary insurance or permanent insurance. Temporary or permanent. Any life insurance contract you have is either temporary or permanent. So let's talk about temporary first. This is also known as term life insurance. If you think of the word temporary, it's only for a moment in time, right? Just temporary for a period of time. And that's what term life insurance is. So there's a beginning and then there's an end date to, that coverage. And it's not necessarily even the coverage, it's really the cost. So most term insurance policies will have, you're covered for 10 years, 20 years, or 30 years. Depending on the insurance company, different insurance companies have different, time periods, but that's, you're averaging anywhere between 10 or 30-year periods. And that's why term insurance is actually very, very affordable because you're only paying for it for a period of time. You're paying for a death benefit just for a period of time, 10 years, 20 years, 30 years. But there's more to it than just, what happens if I pass away. When we think about term life insurance, I think of this for folks who have high responsibility, meaning like you got business or you got little kids, you're the sole income owner, you're paying the mortgage, like you got a lot going on. You have a lot of responsibility that your income is responsible for. I like term insurance for those who have a high responsibility, meaning so that equates to you have a high insurable need. You need a lot of coverage, but you can't afford, you have a small budget. You have a small budget, but you have a huge need. Term insurance is actually perfect for that type of scenario. So for example, like I have a couple term insurance policies, and the way that I really structure, and again, this is just me strategically planning out what am I having this coverage in place for, is I base it on my children's age at the time that I bought the policy. I think my youngest was 9 years old at the time. And I said, you know what? I'm going to get a 30-year term, like the longest term. And the reason why I'm going to get this 30-year term is because right now, mortgage, paying for children, they might go to college. Who knows? I have a huge need right now while my children are younger. But in 30 years, my children won't be kids. They'll be hopefully grown, self-sustained adults. And at the time, my youngest will be 39. But guess what? I don't need that amount of coverage no more. My responsibilities have changed. My kids are grown, they're out the home, you know, so I'm only going to get coverage for this point in time. But God forbid, if something happens to me while they're still young, while they're still, you know, growing up, there'll be more than enough money for them. So that's how I structured my own, one of my own term policies. But so let's talk about how does this work? So we have coverage in place, you know, for a period of time. But what happens to that policy when the term ends? So first of all, there's a couple scenarios, you know, you could be like, you know what, I don't need that coverage anymore. That would be my scenario. Once my term ends, I don't need that much life insurance anymore in a term policy, because my term policy is pretty huge. It's pretty significant. Here it says, if your children are grown and independent and their education and home are paid off and your home are paid off, your financial responsibilities have decreased and you no longer need that term policy. You can just let it go. You can let the policy go. It's done. You had it for your 10, 20, 30 years, and then we stop. So I equate that to like, because some people, they'll be like, well, why would I get term insurance? I don't get anything out of it. If I live beyond the term, well, good job. You lived. You didn't pass away, which is great. But if you did, your family would have had that coverage. So I kind of equate term insurance a little bit to like having car insurance. You need it. You know you need it because Lord happens if you got a car accident, you don't want to be without insurance. You don't want to not have that money to pay for a new car or repairs or whatever it is. Term insurance is kind of like that as well. I need it, and God forbid nothing happens to me. But if something did, my family will still, you know, greatly benefit from that. So scenario 2 could be, you know what? You actually still need the insurance because you're living a long life. Maybe you still have a mortgage. Maybe there's only one person in the household who has bringing income. Maybe your responsibilities haven't necessarily changed. Now you have grown children and grandchildren at home with you. Maybe you have a business that is a responsibility. So scenario 2 means that you still have responsibilities to cover, so you still need a policy. So in that instance, there's a couple things to look at. Well, for one, there's a couple things to consider. So just because that term ends, it doesn't mean your policy just cancels out automatically. And I think that's a big misunderstanding that people don't understand. Technically, the term is only the term purpose is only to lock in your cost of insurance for the period of that time. So for example, let's say you are young and healthy and you got a term insurance policy and it was like $10 a month. Your $10 premium that you're paying every month is locked in. Let's say you did a 30-year policy, but now you're 30 years older, the policy is about to end, or that term is about to end. What happens is it's just your cost that changes because we locked in that $10 a month. Now at the end of the 31, they're going to be like, okay, now this person is older. Let's reevaluate the cost for this policy at that older age. How much would it cost now to insure that person? And so we see dramatic increases in the cost of a term policy after that term ends. And that's why most people cancel them, is because it costs too much. You're literally going to go from like $10 a month to $400 a month. Like, it's insane. That's how dramatic it is. And every year thereafter, the cost will continue to increase. So most people don't keep these policies beyond the term if they're still alive. But let's say you can't afford the policy no more, but you're like, you know what? I need coverage. I still need coverage. Maybe I need to get a new term policy. Well, first, the question is, you got to qualify again. Remember how I talked about earlier, insurance isn't something you could just go on the store and pull off the shelf and put in a cart. You actually have to qualify for these policies. So it could be a point where you don't qualify for a new policy. You're older, maybe your health has changed, or if you do qualify, it's just going to cost a whole lot more. Cost a whole heck of a lot more. It's not going to be that $10 a month. It might be $100 a month. And that's where it gets to a point where term insurance doesn't make sense. It does get to a point where the cost, it's going to be too unaffordable for some folks. You don't want to spend all your extra money on life insurance. You really don't. So we got to really find that happy medium. So, in this instance, this is where we might consider, permanent protection as well. So let's kind of look at this graph here that I have. It's called the financial X-way, because I think this helps you visually understand like where a certain type of policy makes sense. So kind of follow me from left to right. The left side is this blue area. This is someone, and this kind of just, as we go from left to right, just think of getting younger to older in life. So on the left side, you're younger, you're just getting started. Maybe you're just graduated, just purchased a home, just started your family. When we're younger in life, we tend to have less wealth because we're just getting started in life. We haven't really started saving, really probably haven't, reached our peak income earning years yet. We're just getting started, but we tend to have a whole lot of responsibility, a lot of debt. We got kids, we got family, we got to have mortgage to worry about. So less wealth, more responsibility on the left side of the curve. Now, ideally, as we get older and we move to the right side of the curve, our wealth should increase over time, right? Like you're saving more, you're putting into your retirement accounts, that's your job, you're investing money. Our wealth tends to increase, and ideally, our responsibilities decrease. What I mean by less responsibility? Well, now the kids are grown. They're older and out the house. So I don't have kids to take care of anymore. Remember we talked about like the empty nested person? My mortgage is about to be paid off. We're talking 20, 30 years. Hopefully the mortgage is close to being paid off. No debts are in place. So as we get older, we should have more wealth and less responsibility. Now that's the ideal situation. Now, does it happen like that? No, it doesn't. Unfortunately, I see a lot of folks with still not a whole lot of wealth, but still a lot of responsibility. Debt is a major, major issue in our country. So when we think about just this life cycle, at the bottom here, it talks about when does it make sense to have term insurance versus permanent insurance. So term insurance, the sweet spot is when you have the most responsibility in your life. That's when you want that coverage, 10, 20, 30 years. I have the most responsibility. Having that extra coverage at a low cost will be super ideal. But then permanent insurance, which I'm going to share next, permanent insurance is for your entire lifetime. This is when, permanent insurance makes sense as long as you can afford it, from when you're young all the way to older in age. It's in permanent. It's intended to be there your entire lifetime. And so I'll also say you might want a combo of the two. It's not just one versus the other. You might do a combo of the two. So let's talk about permanent life insurance, because these are more involved strategies and solutions to look at. So permanent life insurance is just like it says. You're going to have protection, for your family, but it's intended for your entire lifetime, not just for a moment in time, not just for a term. So this is not only, starting a policy, however old you are, younger in life and getting older to end in life, as long as you pay your monthly premiums every single month, that policy will be there. Because I have had people come to me, someone passed away and they're like, we contacted the insurance company and they're not paying out the death benefit. Well, were they paying on it? I mean, that's the first question. Were they paying on it? Was there enough money going into those policies? Because they're very unique in how they're structured. So one thing you'll notice is that not only is it just, death protection, it says you can have supplemental tax-free retirement income here. You can have long-term care protection. And in addition, you get that tax-free death benefit for heirs. So I want to just touch on these things because this is what makes permanent insurance unique compared to term insurance. So first of all, permanent insurance, we have life insurance coverage for life. We're not necessarily paying for life. You can structure it to where you pay 10 years, 20 years through age 65. You can structure there's a lot of flexibility in how you can pay these policies, but the coverage, you pay enough so that the coverage will last you your entire lifetime. But the second important benefit is long-term care, which is an optional rider. And this is a huge benefit that a lot of folks, I don't think they just realize they need to take advantage of protecting, having monies available for that need, but also like, what does it do? What does it actually protect? And then I think the other benefit that a lot of people might hear about is permanent policies usually can accumulate some cash value inside the policy. You can actually grow money inside of a life insurance policy, if it's structured properly. So when we think about that cash value benefit, remember I talked about earlier that, when we think about what can life insurance be used for, this cash value that can grow inside of a permanent policy can be used for those future expenses that I was talking about earlier, retirement, paying for kids to go to college. Once that cash is available in your policy, you can use that money for anything. It's not dependent upon an age. It's not dependent upon a reason. You can pull it out for anything. You could be like, you know what? I want to buy a car with that money. And actually, one of my colleagues did this. They had a permanent life insurance plan, had enough money to purchase a brand new car cash, because of how much cash grew in. You can use that money for vacations, weddings, whatever you want. You can start taking out income for, the rest of your life. There's so many benefits of what you can do with that cash. Now, I will say to keep in mind a couple things is that with these permanent policies, there are like surrender periods. The cash can grow a few different ways. A qualified insurance professional will explain all those details to you, to let you know. Because even though the cash grows, it takes a long time to grow. It does not happen overnight. We're talking 10, 15 years before you see that cash really grow, and let alone be available to you, because there's usually a surrender period for that same amount of time, meaning surrender means that cash is there, but you can't access it. It's not available for you to touch until that surrender period is over. 10, 15 years later in the future, now you'll be able to access that cash. Again, it doesn't depend on your age. It just depends on that surrender period. So you could pull money out in the form of a loan or withdrawal, and you don't have to pay it back. Usually you don't have to pay it back, which is a nice feature. And that cash that grows inside the policy, it grows tax-free. So the IRS, it's a special IRS tax code, 7702, where you can grow cash inside of a life insurance policy. You don't pay taxes on that growth. And when you pull the money out, no taxes either. No taxes. So this is a huge tax advantage strategy. A huge tax advantage strategy. And because the cash grows inside the policy, it can be used as collateral. I've seen some places use that as collateral because it is an asset. We can potentially have significant amounts of money growing inside this policy. It's also creditor free, because with with any life insurance, you name a beneficiary, it's not available. It's not, in most instances, it's not considered like, because it's not, how do I want to say this? Because it's not like a bank account or like a very, what we call liquid asset, no creditor can make claim to the money inside of your life insurance policy. Also, for example, like if your child was going to college and you save this money for them to go to college, when they do their FAFSA application, the FAFSA free application for federal student aid, the FAFSA doesn't consider this an asset. It's a non-reportable asset. So you can have thousands and thousands of dollars inside this policy set aside for your child. FAFSA doesn't care. So your child will still be able to qualify for the most scholarships and benefits, financial aid. And then if needed, you can use the money out your policy. So again, we're being very strategic, very strategic. And there's zero market risk. In most permanent insurance policies, as that cash grows, it's not tied to the stock market. It's not invested in the stock market, rather. So whether the market is up or down, you don't lose anything, which is a huge, huge benefit. So let's touch on a couple factors. So this is just kind of like a recap of that cash. You don't lose any of it. Once it's there, it's there. You never lose it. You can have tax-free legacy in the form of the death benefit. That cash grows tax-free. You can pull it out tax-free, and you can have a long-term care benefit, covered or added to the policy, which is what I want to actually touch on a little bit, because we have to think about life insurance beyond just if I die, it's available. As you can see, you can grow cash inside this policy. Now I want to touch about this long-term care benefit, because Long-term care is it's a huge potential that can happen to a lot of us. 70% of people over age 65 will need some type of long-term care services or support in the future. So 7 out of 10 of us will qualify for long-term care needs. However, only 8% of people over 55 have any type of coverage, insurance coverage for this. So let's be clear about what is long-term care, because I think a lot of people just have some misunderstandings about it. Long-term care insurance is for you to pay for qualified services like nursing homes, home health care, assisted living care, adult daycare. When you can't perform 2 of the 6 daily living activities, which are, I'm looking at my note across my computer, which are walking, bathing, eating, toileting, dressing, and transferring. If you can't perform 2 out of those 6 daily living activities, you qualify for long-term care. So just take a moment and think, is there anyone that you know right now who needs help bathing, putting on their clothes, having someone come over and cook for them, having someone help them, get out of a chair and into their bed or into something else? That's long-term care. And the big misunderstanding is a lot of people don't realize is that your normal health insurance won't pay for that type of assistance. Your normal Medicare that you get from the government, if you're over 65, does not pay for long-term care. You typically, if you want that type of help and assistance, it comes out of your pocket. It comes out of your pocket. Now, will the government, and obviously our IHSs, our tribe, the Internet Health Service, they might offer something. But in most instances, when you need that one-on-one assistance, and it's not based on, I have an illness or medical diagnosis or condition, I'm just old, I need help. That type of assistance comes out of pocket. So it's not just for the elderly either, because some people will say, well, I'm not old, I'm not a senior, I don't need this. 37% of people who qualify for long-term care are under the age of 65. One of my colleagues had a client who, I'm based in the Midwest, I'm in Chicago, who their client was in downtown Chicago, got into a major car accident. Like underneath our city, we have like these concrete, it's called Lower Wacker Drive. Wacker Drive is all concrete. It's underneath our city. It's roads that, it's really kind of scary because you can't really see. GPS doesn't work really well down there. And anyway, his client was like 20-something years old, driving on Lower Wacker Drive and crashed into one of the concrete barriers, like poles, like big concrete things in the middle of the road, and was paralyzed from the neck down. That's long-term care. Because when you're paralyzed, you can't do nothing for yourself. And so it's not just for old or sick people. Any one of us could suddenly qualify for something like this. You never know when you might need it. Again, we always encourage folks, this is something you want to secure while you're younger and healthier, because that is when it's the most affordable and easiest to qualify for. So I wanted to show an example of what do these costs look like. So when people actually do qualify for long-term care, like think of someone who had like a massive stroke and now they need help. Like I think one of my sister, one of her good friends, was in his mid-40s, had a massive stroke last year. Now he's, paralyzed on one side. He needs a lot of help. He had to move back in with his mother to help take care of him. That's long-term care. Like I'm trying to just emphasize, like, this is not an old people thing. But anyway, so when we think about the costs, this is from 2018. So these costs have increased. Adult day healthcare, $18,000 a year. Assisted living facility, you want some privacy? Oh, you're going to pay $48,000. If you're a semi-private room, nursing home, semi-private room, $90,000 a year. You want a private room, $100,000 a year. I tell a lot of my clients that I talk to, you can have all the money in the world until you get sick. And if you don't have long-term care coverage, you will go broke paying for this type of stuff. And again, everybody's situation is different, but I just want to make it clear, don't depend on the government, and don't think that your workplace health insurance takes care of this. They do not. They will pay for 20 days in like the hospital or maybe a facility, and that's it. 20 days. The average amount of time that people have this need is 4 years, almost 4 years. So you will go broke. I've seen this happen. I've had a client. She was a client of another advisor I used to work with a long time ago. This was a single woman. She was living in a nursing home. She had, I don't know, probably $1 million or more in her investment account with that advisor. And every month she had to withdraw like $10,000 a month just to pay for the healthcare costs at that time. And that was 20 years ago. And I remember talking to her on the phone. I was like, man, you really don't spend your money. She was like, no, because I can't, because I need every single dollar to pay for this nursing home because I don't have no one else who can help me and take care of me. And then, also I want to let me just touch on this. I'm sorry, I got to talk about it too, because I've seen people say, it's not uncommon to say, well, my family members will come in and take care of me. They'll do that for me. Of course we will. Of course family will do that. Women will quit their jobs to do that. I remember when my grandmother was diagnosed with ovarian cancer. It was my 3 aunts who stopped working because it was a full-time job, changing her and feeding her and taking care of her and watching her. And then the home health aide would come in for maybe a couple hours a day to change, and they were gone. So she needed round-the-clock care. You can have this benefit to pay your relative to do that for you, because it's not only the most stressful job, it's taxing on a person's body to have to be physically moving you and lifting you and things of that nature. So at least the benefit from this type of coverage can pay somebody to do that for you instead of them, getting into a horrible financial situation to help you. So, all right, let me move on, because I could talk about this a whole hour, but I'm not. Let me move on because we got time. I gotta always be mindful of time. So anyway, hopefully you see that's a need that needs to be covered. So a couple ways to factor in or cover this long-term care need is to get a traditional standalone policy. This is where you go directly to an insurance company and they sell long-term care insurance. That's all it is. It's not life insurance. They only pay for long-term care insurance. But that's what they only offer. The second option, like, why am I even talking about this, is because you can add this benefit as a rider to a permanent life insurance policy. So if you're getting permanent life insurance, you absolutely want to add long-term care protection. It does have an extra cost. We're talking about $2, maybe $4 a month for the benefit. I mean, it's worth the cost. So with the traditional standalone policy, what we've seen, and the reason very few people get this type of policy anyway, is because it'll start off affordable, but insurance companies can raise rates, and they do raise rates. The few people that I know who do have a separate standalone policy because they got it decades ago, they are paying so, 2, 3, 4 times than what they started with. If they do use the policy, they're paying for care out of pocket and then getting reimbursed. Like, who has money to pay $2,000-$3,000 out of pocket for expenses and then waiting on a check? A lot of people don't. There's a 90-day waiting period for that. And since there's a 70% chance you'll need long-term care, we also have to factor in that there's a 30% chance you won't need it. If you get a traditional standalone policy, if you don't need it, you could be spending all that money and then you get nothing. You don't get your money back. So that's another factor. Like, do I really want to spend thousands and thousands of dollars on something that there's a 30% chance I might not need? So option 2, which is what I typically recommend, is to have it added to a permanent life insurance policy, literally for a couple extra dollars a month. Life insurance companies don't raise rates. They pay you to cover those expenses after a waiting period. Most insurance companies, some insurance companies have a reimbursement method. The ones I work with, they don't. They just have a cash indemnity benefit, which means if your doctor says you qualify for long-term care, the benefit is automatically, added or triggered rather with the doctor's note and medical information to confirm that. And the insurance company just sends you the money month after month. So you can definitely, huge benefit, huge benefit. You can have significant savings. by incorporating the long-term care into the life insurance protection. And if you are one of the lucky 30% who don't need long-term care, guess what? The money that you put in isn't wasted. Instead, your family will get that as a tax-free death benefit. So something will come back. All right, so let's move on real quick to start wrapping up here. So other living benefit riders that can be added to policies, and these living benefit riders are usually built into not only permanent policies, but term policies as well. Because even though I said term insurance, it doesn't grow cash, and I kind of equated to like having auto insurance, they actually term insurance policies can also have living benefit riders. Not all insurance companies offer them, but most of them do now, which can also give you some extra protection. So in the event of a critical illness or chronic illness, you could actually qualify. You could submit a claim on your term insurance policy, and based on the severity of the illnesses, you could actually receive a portion of your death benefit while you are alive. So you can cover your expenses, take care of yourself, and then whatever's left over will be, remaining as a death benefit that'll pay out when you actually pass away. So these they do have to be pretty significant, illnesses. So like having a heart attack, a stroke, cancer, are critical illness examples. Chronic illness could be like ALS, diabetes, Alzheimer's. Critical means, it's something that happens sudden right away. Chronic means you're normally living with it over a long period of time. And it has to impact your, what do they call it? How long you live. It has to impact your longevity. I can't remember the technical term. If you had, because for example, I have had clients who had, unfortunately were diagnosed with like breast cancer, but because it was caught so early and they were able to get rid of it, it didn't drastically impact their lifespan. And so the benefit actually did not cover them, even though it was cancer. It was technically a critical illness, because it wasn't a huge impact to their, their longevity of life, their expected lifetime. Their expected lifetime. And it didn't actually, they didn't qualify for the benefit, which was unfortunate. I'm like, but guess what? It wasn't severe enough. So it has to be actually pretty significant that will affect your expected lifespan. So let's transition to talking about, which one should you apply for? And then we'll talk about the application process. So when we're talking about which one should you apply for, when you think of, term versus permanent, a term, a couple of factors that I think make sense is, again, if you have a huge need but a low budget, huge need but a low budget, you want the most protection at the lowest cost. So maybe you might have, let's say, $1 million insurable need, but $1 million in permanent insurance is going to cost too much. You could probably get $750,000 in term and the other $250,000 in permanent. So that way you can at least have the most protection at the lowest cost. Term is a good way to start. It's a good budget. It's a good policy to start with. Like maybe you don't have the income just yet, but you're like, you know what? I'm just starting out. I'm starting work. Maybe my income will go up. Great. Start with term. Like I use my term policy for until my minor children become self-sufficient adults. I want to have coverage, while that responsibility is there. If you have large debts, if you're a single person, if you could benefit from those living benefits, or you just want that protected. And if you're like, you know what, I really want to get a permanent policy, but I know I can't afford it because it does cost more. Permanent insurance costs probably about at least 2 times the cost of term insurance. But if you're like, you know what, I want to, let me get some coverage in place and eventually I can convert it to permanent, then I'll do that. So permanent policies really make sense for those who have stable income. Like the worst scenario is you getting a life insurance policy and then you stop paying it and you, for whatever reason, you can't afford it anymore. Like that's the worst case scenario. We want to make sure whatever it is, it's affordable, it's sustainable. If you want protection and you want to have that, cash flow, that tax-free money growing safely, permanent policy would make sense. If you really desire to leave a legacy, if you want that long-term care need covered. So you are able to convert term policy. I mean, and then more importantly, you just want peace of mind. Peace of mind. Like me in the hospital bed in the emergency room, complete peace of mind. So you really want, you should know you can convert a term policy to permanent. Usually the insurance companies, if you're like, let's say you started out with a term insurance because you're like, man, I think I really want this coverage. I just can't afford a permanent policy just yet. Usually within the first 5 years of that term policy, the insurance company will convert it to a permanent policy. And what does that mean? It means that you don't have to requalify from a health perspective. Let's say you had a change in health. You were once nice and healthy, then you had a diagnosis that changes things. If we do a conversion, like if you had a term policy and now we convert it, the permanent policy will take on your previous health rating. You don't have to requalify it. It's like you automatically get a permanent policy, and then you maintain that permanent policy at the new higher premium because it will cost more, but at least you didn't have to like requalify for it. And also too, when you do conversion, I should have did a slide on this, but I didn't. When you do conversion, you also, you cannot convert it to a permanent policy for death benefit higher than your current term. So let's say, for example, you bought 100,000 term policy. The most you could get on permanent is 100,000. You can't get higher than what your term policy death benefit is. If you want more, you just have to apply completely brand new with that permanent for a permanent policy at that higher death benefit. You can convert it for less. So let's say, for example, you have a $500,000 term policy because your responsibility was so high. You know, you had so much responsibility at that point, but now you're older. You're like, you know what? I don't need this $500,000 anymore, but I do need permanent. Let me just convert $100,000 to a permanent policy. You could do that as well. And the last thing with conversion, and again, now that I realize I should have did a slide just to talk about conversions, is that even if you convert a term policy to permanent, it doesn't mean the term policy actually cancels. You have to contact the insurance company and say, okay, I've converted this policy. I'm going to cancel it because now you'll have two policies you're paying for. Now, some people might be fine with that. They might be doing that strategically, but if you're like getting rid of one for the other, you have to make sure you actually cancel the term policy. Okay, so let's talk about what factors affect your insurability. Because again, when you're trying to get life insurance, you're submitting an application. You're going to go through what's called underwriting, which is the process where life insurance company reviews basically your risk level to them. Because you got to think about this. A life insurance contract is just that. It's a contract. So the contract says if this person passes away, we, the insurance company, we have to pay out this death benefit to their beneficiaries. And so insurance companies try to do a good job of evaluating like what's your risk level to them. And that will also determine how much your policy will cost, your cost of insurance, which are your monthly premiums. So everybody's costs are different because it's looked at different factors here. It's based on your age, your height and weight, which is also known as your build. And I want to touch on that real quickly because insurance companies, they use actuarial tables. I don't know if I'm saying that word right. You guys gotta forgive me. Look, I'm from Chicago, okay? Sometimes I talk funny. I can't pronounce certain words. They use actuarial tables, which, excuse me, is basically their old tables where they can literally say, oh, you're 41 years old, you weigh 200 pounds. We can estimate that you'll pass away at age 84 and a half. A little freaky and weird. But anyway, so they factor in like, okay, what's the possibility that this person might pass away? How healthy are they? How unhealthy are they? Are there major medical diagnoses that we need to be aware of? So they look at your height and weight. Excuse me, I just got a little cough, which is your build. So they'll look at how tall are you versus how wide are you. And if you're like really short and really overweight, that doesn't look good. You know, that affects your build. I've had that happen with clients, unfortunately. But insurance companies actually give insurance agents like charts, so we can kind of figure out where you might fall on the spectrum. If there's no, I'm big boned and this is healthy in my family, like insurance companies that just have their own tables that they look at based on every living adult, man and woman. Excuse me. I didn't mention that on the slide here, but insurance is applied as male or female. I do understand we have relatives who might be two-spirit or they might have different gender identities. Insurance companies, some of them will take your application on the gender that you identify with. Excuse me. Other insurance companies go off of your biological gender at birth. So if you're like trying to figure out which one, I'll be happy to share some companies, offline individually if that's a concern. But I do have to mention that because of, we do have folks who do have different identities. Insurance companies, in the application, they'll ask you about your medical history. You'll likely do some type of questionnaire or even maybe a paramed exam where they'll send somebody to come out and take some blood or urine from you to see, like, do they find anything? Are you disclosing all that information? What prescriptions are you on? What are these prescriptions for? Is it for a medical diagnosis? Like, what condition is this for? Are you a tobacco user? The tobacco usage is super important because non-smokers, nicotine smokers will pay probably about 2 to maybe sometimes even 3 times the cost versus a non-smoker. So tobacco users, you do pay more. Family medical history is considered, especially if there's like a history of maybe cancer or somebody passing away young. And what I mean by that is like age 50 or earlier. Insurance companies will probably ask, like, what happened to that person? How did they pass away that early? Driving records. Insurance companies do not like DUIs. If you have a DUI within the last 12 months, you're not getting qualified. They will deny you until that 12 months. Some of them have a 2-year period with DUIs before they'll even consider giving you coverage. Criminal records. If someone's currently incarcerated, they cannot get a policy approved. And depending on the exact criminal charges or whatever happened, like the severity of it and whatever it was, they might decline someone based on criminal record. Not like shoplifting or some little misdemeanor, but something serious. I don't determine what's a significant criminal background. In high risk activities. So that would be like jumping out of airplanes. Do you like race car driving? Are you a scuba diver? Like, do you fix, light bulbs on windmills outside? Like, what's your job? Is it a high risk job? And as silly as it might seem, the insurance companies ask about these things because they're trying to determine, again, the level of risk that they have to take on, and considering like how long would this person could be expected to live before we might have to pay this benefit out. And I'll tell you this, you absolutely want to disclose anything. I'm not saying if you have diabetes that you can't get coverage. You can. Insurance companies will tell us we need their A1C number to be 9 or below, and then we'll give them coverage. Now, if it's beyond that, they want you to work on that and come back. It's not to say if you have a history of cancer, you can't get coverage. You can get coverage. Just disclose that information, because if you don't disclose it, and they find out, it's not going to be looked at highly at all. Or if you don't disclose something and the insurance company missed it during their underwriting process, there's a 2-year contestability period where the insurance company could say, wait a minute, this person just died. We just issued their policy. Did we miss something? Did they not tell us something? They can go and they could deny coverage until they go into like a deeper check and see, like, did they not tell us something about in the application process that had we known, had they been truthful with, we otherwise would have declined them. Unfortunately, I had that happen to someone else. As an agent, I can only ask so many questions. I tell people, please be truthful, please be honest, because if you tell me like what your current history is, I already know which companies to go to and which companies to avoid, because I already have an understanding of how they, will review someone's health history. So be very honest and upfront. You don't want them to find out something and then it can cause problems if you end up passing away and they contest it. So real quickly to go over the application process, and Brooke, if it's fine, I don't want to rush, so I might go just a few minutes past the mark here. For the application process, but I'll go through it as quickly as I can. First of all, you get life insurance with an actual insurance professional. So you want to discuss your current financial situation with someone. You really want to be clear on what can I afford, what's comfortable for me to pay month to month. And then also determine which type of life insurance do you want to apply for. Maybe a combination of both. I have both term policies and permanent policies. I have a couple of each type, for different situations. And then also it's important, I think, just to review different quotes from different insurance companies. Some insurance agents only work for one company, so that's all they can offer you. I like brokers, insurance brokers, because they can shop around for you, and then they're not trying to fit a square into a circle. They're really doing their due diligence to try and find something that will fit your scenario, and not trying to force the only option they have on you. So step 2 to the process is just submitting the actual application. So the application, there's 2 ways you could do this. You could do what's called a trial application. This is where you submit an application, you go through the underwriting process, you agree to your medical records being reviewed, you answer all the questionnaires. Again, there might be some exams they might require. But anyway, you go through that that underwriting process, but you don't submit any money with the application. It's just literally to see, can I get approved? I might, I do this, actually, all my applications I do with my clients are trial applications. Because I want to see, like, I would love to have you have these great policies, but I don't know if you'll get approved. So I do trial applications. And that's usually what I recommend, so that you can see, will I even get approved? And if so, the insurance companies will let you know what's the issue, or do they need more information? So it's just a really good process to gauge, like, where your insurability stands. And it's something to understand too, is every insurance company has different requirements. So just because one insurance company might say no, another company might say yes. So keep that in mind as well. Now, with an application, you can submit what we call a full application, and that's where you also provide your first month's premium with the application as well. And what that does is you're basically telling the insurance company, like, I really want this policy. I expect to get approved, and I want my coverage to be effective from the day I submitted the application. And that's what we call you getting receiving what's called a conditional receipt. And the conditional receipt basically says that, because underwriting can take some time. Now it's actually a lot quicker nowadays. But the conditional receipt says that, let's say I submitted an application today. It's Tuesday, May 27th. And unfortunately, I pass away tomorrow. Very unfortunate. But I submitted the application with the premium because I have every intention of taking the policy. So let's say I submit the application today. I actually pass away tomorrow. But the insurance company comes back and says, you know what? You would have actually been approved. We got enough information. Everything we were able to review was clear. We were going to approve this policy for you had you been alive. The fact that I submitted that first month's premium, that conditional receipt, now says that because I did that, the death benefit that I applied for will actually be able to be paid out. Imagine. I mean, I've seen this happen with some of my other colleagues. Somebody even submitted a life insurance policy. They were going through the underwriting process. They passed away during the underwriting process, but because they would have been approved anyway, and they submitted that first month's premium, their family received like a $500,000 check. Mind you, they only paid like $60 for the policy. That's the power of a conditional receipt. So for some folks, if I know they have a good chance of getting, like, they're healthy, they'll get approved, So I'll offer that as an option. Now, insurance companies in their underwriting, they might have more questions. They'll ask a bunch of questions on the application, but they say, you know what, we might have more questions. We saw XYZ in your records. What is that? Can you tell us more? Did you finish that testing? So when you're doing the application, you're signing a HIPAA authorization form so that they can go and find information. So that's why I tell folks, try to be as honest as possible, because they're going to find the information whether you tell them or not. So just be open about that. So you want to make sure you answer any question. If they require an impairment exam, a phone interview, you have to complete those before they can make a decision. So then that's the underwriting process. It can take a few days or a few weeks. Most insurance companies that I work with, they can actually do this pretty quickly, like a couple of days. I've seen like 4 days, 2, 3, 4 days. Pretty crazy how they, because of the access to electronic records and things, they can make decisions pretty quickly. So the insurance company, once they review everything, they're either going to approve your application or they'll make an offer with changes. They might say, yes, we'll approve it, but we might have to charge you a little bit more because of something we found, something like that. Or they might just decline your application altogether. And you'll find out why. They will tell you, we found this was too much of a risk, or we didn't get all of our information, or, they'll let you know why they declined the application. And then at that point, you can accept that insurance company's offer. You can say, great, I got approved. And now we start paying the monthly premiums. And that's when the policy is actually enforced. When you make that first month's premium payment, now it's actually enforced. And if something happened to you from that moment forward, you're covered. You're covered. And then at the end of the day, I always tell folks to review your policy at least once a year with your life insurance professional. All right. So real quick on naming beneficiaries. When you complete a life insurance application, you do name beneficiaries. This is who will get this money if something happens to me, if and when something happens to me. So you have a primary beneficiary. This is the person or persons who receive the total death benefit at the time of death. That could be one person, that could be multiple people. If it's multiple people, it doesn't matter. You just have to allocate how much of a split do you want them to get, and it equals 100. And it doesn't have to be an equal split. You could do 10% for this person, 20% for that person, however you want to work it out. I always recommend you to also name contingent beneficiaries. Contingent means they're next in line if all the primary beneficiaries have passed away also. Like I said, I always recommend at least naming one contingent beneficiary. Although it's not required, you do have to name primary beneficiaries. And one thing I always encourage folks is you want to avoid naming kids as beneficiaries. And the reason why is because they're not adults. The insurance company is not going to mail a child a death benefit check for whatever that amount is. They won't have access to that money until they become a legal adult. So if you're worried about that, I've had some clients who said, well, I don't know who else I can trust. Who else, why would I not name my 2-year-old son as a beneficiary? I'm like, well, you should probably get a trust then and name your trust as a beneficiary. That's a webinar I did last week and talked all about. Okay, so let me just hurry up and rush up. So as you can see, I hope you can see that why people would feel more secure with life insurance. 68% people feel more secure. If you have any questions, I haven't seen any questions come through, excuse me, specific to my presentation. The last thing I'll just share is that people don't plan to fail. Don't plan to fail, they just fail to plan. We know that this can happen. And again, our cultural practices might prevent us from having a conversation, but it will happen. We should plan for these things. This is my contact information. I'll be happy to have a conversation with anyone to discuss your life insurance needs. You don't have to get anything from me, but I'll be happy to educate you further or to discuss, what makes sense for you. You could definitely schedule a 30-minute consultation with me. That's no cost, no obligation on either of our behalf. You can email me to get on my newsletter or connect with me on social media. So I appreciate you all for letting me go over 5 minutes. And Brooke, I'm going to pass it back over to you. Thank you all so much.
No worries on going over, Shantae. It's super important information and it is totally, totally fine. I have put the link for the webinar feedback survey into the chat, folks. It only takes about 3 minutes tops to complete. Lets us know what is working well, what we can improve upon. We do share the feedback with our instructors, so it helps them too. And they are anonymous, so you don't have to feel weird about your name or your email or anything being connected to the survey. We hope you can join us for our next webinar. That's going to be next week on Thursday. This one's going to be on proposal budget design for grants. This will be instructed by Diane Leonard. You can access this as well as our other recorded webinars on our YouTube channel. We have a Cathedra webinar archive. The link for that is in the shared notes, and I can put that into the chat quickly as well. The recording for today's webinar will be ready at some point tomorrow. It has to generate, but that'll be on YouTube then, and then you can also access it here on the learning platform if you just click through the Understanding Life Insurance course. We hope you can check out our upcoming events. We post about them on our various social media. We're on Facebook, Instagram, LinkedIn, Twitter. If you're a podcast listener, we have an in-house produced podcast, the Hope a Thing, a Native American podcast. You can listen to that wherever you listen to your podcasts. And otherwise, that is all we have for you today, folks. Thank you so much for spending your time with us. We recognize that you could spend it anywhere else, so it's fantastic you spend it learning through the webinars. We hope you have a fantastic rest of the week, and we will talk to you again soon. I'm not going to end the meeting so that all of you still have access to those links in the chat as well as the shared notes, but I will turn off the recording and say goodbye for now.